That's great. All right, well, let's start flying through the other areas because I'll make sure I do cover them off. So I want to have a bit of a look at what sort of impact this is going to have on retirement portfolios. We've sort of touched on that a little bit already. So we sort of, I guess, just look at it from more of a higher level. But we spoke a little bit earlier about the assumptions have sort of changed. If we go back 12 months ago, we would have been looking, reasonable returns, reasonable interest rates, but now that seems to have all changed. Are you able to sort of provide some comments around sort of what assumptions people should really be building into, I guess, their retirement numbers now?
Look, and to some extent they've actually improved because we've got prices have reset lower.
Yeah.
So at the start of the year, one of my communication challenges was talking to people about, because we've had such strong returns, and we're still 1,000-ish points below the ASX 200's peak of February. At those elevated levels, my communication challenge was to start to say, hey, that 13, 14, 15% that you got in 2019, that's not going to happen again. It might be a third of that. And they were the sort of longer term numbers. We've taken a capital hit. We've captured a decent portion of that back. But the long term from here has kind of been reset. We've had the dividends out. We look forward from 10 years from this point, and at 6,000 rather than 7,200, our return expectations are better than they were in February.
Yeah.
The bit that we're grappling with at the moment is, and I was talking with one of my investment committee colleagues on this earlier today, back in late March, we said we needed to put some adjustments through to our forecast, and particularly how big a hit were earnings going to take and how big a hit were dividends going to take. So back to those first two really important questions. And at that time, we had a base case scenario and we had a pessimistic scenario. So pleasingly, it looks like we can kind of not discard and abandon completely, but for the moment, sideline the more pessimistic scenario. And in fact, we put through some upgrades to the base case scenario. Again, because that healthcare outcome has been better, the policy response has been huge. We know the policy support is going to continue. We've had very explicit words on that. So we've actually relaxed some of those crunches that we put into the forecast model around earnings getting hit, dividends getting hit. Now, different sectors, different countries will come out of this crisis differently as well. But, from a tipping points point of view, we're upper single digits and low double for Aussie equities, low double digits on the financial sector. We're still sort of 8s and 9s around the offshore exposure we've got. There's a key consideration there for us in terms of the currency. And that's a really important impact on international offshore returns. So when we go and buy stuff in Japan or Europe, it's the performance of those underlying Japanese or European companies, but also how does the Aussie dollar move against the euro and the yen. Now, the Aussie dollar acts as a bit of a shock absorber. So that helps us over a full cycle. When the Aussie dollar gets weaker, that shielded the portfolios from the much deeper losses that would have otherwise come through. Since late March, we've actually seen a reasonable bounce in the Aussie dollar. So everyone's probably more familiar with the USD exchange rate. We got as low as 55 cents there, and we're back up to almost 70 at the moment. So conversely, again, Aussie dollar rising has knocked the top off the recovery, but we got the shock absorber effect on the way down there as well. Now, that's fine, but what happens from here? There's a school of thought out there that says the US is in strife and that their currency might be 20-30% lower. Then we've got to start to figure out how does that translate into the Aussie dollar. We don't own any US in the portfolio, of course. Are we going to see Aussie dollar appreciation also against yen and euro, those sorts of things? So that's been an active consideration. For the time being, our situation is we're still very happy to have that shock absorber effect. So if the health situation deteriorates, the economic outlook deteriorates, sentiment deteriorates, equity markets start to roll over again, we'd certainly expect the Aussie dollar to weaken again and we'll get that benefit. And on balance, we're happy to hold that for the time being against further risk against depreciation in the Aussie dollar. But that's a really important part of the outlook on the offshore holdings there as well.
Yeah, and I guess that's a thing a lot of people don't really look at. And I guess since 2008, we've had nearly 10 years, 8 to 10 years of strong investment market. So people haven't had to really think about it. But now, certainly, and I'm finding it with people we're speaking to close to retirement, and particularly in retirement, those who were set up well really don't have any issues, but those coming into it certainly have some concerns. So those looking at all the assumptions, it needs to be looked at and assessed really closely now to make sure that you've got your numbers right as well.
Yeah, look, there's a lot of tendency, and we're not right in the depths of the crisis now, but it's not that long ago. I'm very reticent to draw strong conclusions at the depths of a crisis. I'm sure you and all of your investors have seen no end of headlines that say it's never going to be the same again. We're not going back to normal. It's different this time. And you know what? I heard all of that in 2008 and 9 as well. The valuation piece, that third question that I talk about a bit, the way we describe that is the ratio of price to the underlying earnings. And normally we're sort of 15, 16 times earnings. And at that, that can collapse quickly. That got, everyone got scared. We didn't know whether markets were going to reopen again, and 08 and 9 and in March of this year. And particularly from the GFC, because we're obviously now through that, it's going, the talk was this is going to be like the Depression. It's going to leave generational scars. No one's ever going to pay 15, 16 times earnings again. You know what? Of course they did. Humans are incredibly resilient. And we're already seeing some incredible prices being paid for the leaders in the US equity market, which raises some serious questions about how do they continue to deliver the earnings to justify those ratios. But I'm so very, again, on that and a whole number of other issues, whether it's returning to office or traveling again or whatever it might be, very reticent to draw conclusions that it's never going to be the same again. Yeah. We will get through this. There will be a recovery. It won't be in a uniform fashion. It won't be upwards and onwards and in a straight line from here. And so we, as part of that process that I was talking about before about adjusting expectations within our forecasting model, we can say, okay, if they don't get back to 16 times earnings, what if they only stay at 14? Well, then our expected returns for that asset class are sort of 7s rather than 8s or 9s. Yeah. And that's still all right, particularly as we make that comparison to 1% in term deposits.
Yeah, and it's a bit like... Yeah, it's a bit like, you're a pilot flying a plane and, we've hit massive turbulence. It's, well, okay, how do we sort of get out of this turbulence at this point in time and sort of still stay on track to our destination? Because, and you'd know that pilots say about 90% of the time. It's a great
analogy. It's a really good analogy.
So, that's an easy way, I guess, of putting it. But also, what I have seen, and this is an interesting thing because I've written a little bit in the last couple of weeks on the psychology around investing and the biases that people have, but we've been seeing a lot of people who are either cashed up significantly or they've gone and sold out of investment portfolios and just put it all in cash. Now, we know particularly if people are heading into retirement, there's still another 30 odd years to go. So that's a long investment time frame. What sort of advice will you have to people who are perhaps thinking of or have either done it or are thinking about this is all too hard, I'm just going to put it all in cash?
The danger of that is you've got to be very, very good at short-term market timing, and that's very, very hard to do. There's almost no one who's done that historically on a consistent basis. So, clearly if you knew March 23rd was going to be the low and you were already in cash, let's say at the end of January, you had a generational buying opportunity at, 50, what did we get to, 5,400, I think, on the ASX 200. And you've made great money in a matter of months. Is that realistic? No. There are some who I know who did go to cash not long after or around that market low and are still there.
Yep.
And they're the ones that will tell you it's not over yet. There's going to be a second bounce, and we'll go back and retest those lows. I'm not in that camp. So I think, again, the airline pilot and airliner analogy is a really good one. And while you were talking about that, I was reminded of that Qantas captain, Richard de Crespigny, I think his name was, who was on the flight out of Singapore, and someone will correct me on these details, and had engines blow up. And he remarkably calm, made an assessment. I can still fly the plane. It's still responding. I've got alerts and alarms going off everywhere. People are panicking, but the basis is still working, and he got it back and landed the plane, and everyone survived. Markets are still functioning. They're a bit weird for a while. We hit that patch of turbulence. And, the other analogy that I used to use is if we were flying from Sydney to LA, it's not a perfectly straight line. We make mid-course adjustments. I think that's a useful analogy on a number of levels.
Yeah, and also just for taking stock of certainly where you are, and I sort of look at it back to, I guess, the days where, because emotion plays a lot in this, and our minds do play games, and it's wrestling with our minds all the time. And I do remember the days back when I was doing some martial arts back when I was in university days, and you'd rather than someone was coming attacking at you, you wouldn't go directly at them because you absorb all their energy into clash. It'd be you'd turn to the side, you'd grab their energy and disarm them. So I guess this is the same sort of thing. It's not easy, but I guess if you've thought about these issues before, and I guess a good thing would be that if people back in the midst of the global financial crisis, and I keep having people say this in the industry at times, write a letter to yourself of how you feel at this point in time, put it away, and then bring it out again in the next crisis.
Yeah, or write publicly, because then you're really held to account.
Because there are some strong lessons, and I guess we try and test that with clients as well to get a feeling for what they will absorb and what they won't, between a bit of education and then obviously what their biases are. But it is that constant fight between that emotion and what they should be doing that's right for them. And it all comes back to, well, has life really changed? Is this impact really impacting your lifestyle today? It was just like back in the global financial crisis. I asked this question of a lot of clients, particularly self-funded retirees, and they've gone, well, no, our life hasn't been impacted. And I said, so what's the problem? And they just look with this look on your face and they go, well, there's not actually a problem. It's about thinking it through that way.
I look, amongst all the other, important things you do, I think that's the most important role. That's that role of the counsellor that I was talking about before, which is incredibly important. I guess the other thing I would say is my three colleagues on the investment committee with me have got 130 or 40 years market experience between them. We've seen it before. In some cases, they go back to the early and mid-70s when they started their careers in financial markets. So these things come. There'll be another one. There'll be another one. It'll be different. It'll have its own unique characteristics. It'll be obvious in hindsight. The behavioural traits of the average investor, and indeed collectively the investor community, will be the same. We'll throw the baby out with the bathwater. When you were talking before there, I think in exuberant times you run the same challenges. I often talk about, you've sat down with a client, you've understood their circumstances, you've written a wonderful retirement plan for them, they're earning their 7 or 8% per annum that they need to be on track, but their neighbour's done 13 or 14% in the last 12 months and they get upset. Why would you care? You're on track to hit all your lifestyle objectives. So those behavioural aspects and managing them as an advisor, as an investment manager, but as your end clients as well is important. Whether it's good times, bad times, sideways times, they're always going to be there.
Yeah, and I guess some of that comes back to what I call, recency bias as well. And we've had this challenge with some clients where the markets had been doing really well, and we're sort of trying to say, well, hang on now, because of the growth in the investment portfolios prior to this pandemic, we've had to wind them back a bit, and even that's been a struggle to get them to take some risk off the table. But now they sit and go, okay, well, I'm glad I actually did that, So
that's confirms what I was talking about before, and we try and make that at some level inherent within our process. So that dynamic allocation between asset classes, I spoke before about, we had incredibly strong returns out of property trusts over 2.5 years. And we went from an underweight to an overweight. We let that run. I think in our number 3 of 5 sort of balanced portfolio, we had a neutral of 10. We went to 12, we let that run, and we let that run again. It was gone from 10 to 14. So a 40% overweight to neutral. And in the early part of the second half of last year, kind of around August, September-ish, we went, that's more than that's a lot more than we're expecting, in fact, out of that asset class. And we went from 14 to 12 and then 12 to 10 pretty quickly. We trimmed Aussie equities at the same time as well. So there was 6 to 8%, depending on the portfolio you're in, where we'd taken risk asset exposure off the table and were sitting in defensive stuff. And so that's, at a broad level, at a model portfolio level, the sorts of things that we try and do with a long-term focus, and then communicate about those in the commentaries, of course. And then, as you know, the ongoing interactions on an individual portfolio level with the portfolio management team can be much more sort of targeted and individualised there as well.
Yeah, and I guess adding to that, I guess one of the things that we've done, particularly, I have personally with clients, is over the years is not so much focus on the investment return, and I guess we've turned it around and created, I guess, a personal benchmark for clients to benchmark themselves again, and that has nothing to do with return. Yes, you want to get good return, you want to make sure you're getting, value for the risk that you're taking, but it's that personal benchmark as well that, it's really about that lifestyle that you want to live. That's really what matters, not so much the return you receive from your portfolio.
Yeah, and not what your neighbour's benchmark is. Who cares?
Well, the Joneses, yeah. So it's not based on them either.
That leads to sort of turnover and fees and taxes and ultimately poorer portfolio outcomes, yeah.